All right, let's continue on here. We're talking with Dan. Dan, you're with Allworth's Money Matters.
Good morning.
Hi.
Hi. You want my question?
Yes, please.
Sure.
Okay. I just heard the previous conversation, and this touches on that a little bit. So you've talked about setting up, stock ownership so that you can tax harvest the losses. Can you do anything similar with bonds?
Absolutely.
Bond funds?
Oh, absolutely.
Yeah?
Same way. Yeah.
So in 2023, when the bond market crashed, could have sold off those bond funds and...
We did.
Yeah. All right. And then rebought the similar bond fund and realized the gain.
Yeah, you can't. So there's what's called a wash sale rule. So you can't sell something and immediately buy it back. You have to wait, is it 30 or 31 days? But you can buy something similar.
But not identical.
Right.
But not identical.
Right.
So you can't sell a Vanguard fund, ABC fund and buy Vanguard ABC, but you can buy ABD
if it's slightly different.
In fact, you should. Across the whole portfolio, you should. And quite frankly,
assuming this is when you're outside of retirement accounts. If it's inside retirement accounts,
it doesn't matter.
Right. I understand that.
Yes.
Yeah.
But for the rest of the listeners, and in fact, there are programs now that you can actually apply to your portfolio that will do it automatically. So what happens is, imagine you've got like this portfolio that's got these 12 holdings in it, and it's in a brokerage account outside of an IRA, and it's got these 12 different holdings in it, right? We're not talking about direct indexing now. And you've owned these portfolios for years and years. The first thing you do is you quit dividend reinvestment and capital gain reinvestment because you're going to pay taxes on those anyway, and you actually funnel those off. We just did a very, very large account that they had been with the same advisor for years and years, and the advisor kept telling them how great they were, but they had dividend reinvestment and capital gains reinvestment for the last 10 years. I'm like, this is just...
They're already overweighted in a particular area.
And this is
some
just...
fund they've had for 25 years.
And this is just lazy. It's just, that's flat out lazy. And so what happens...
That was in a brokerage account?
It was in a brokerage account. So the first thing we recommended at the very first meeting, even though the money was at the another firm, we're like, have this go to cash. And when that cash accumulates, then you go back and rebuy a position, hopefully tax efficiently. But these programs will actually build multiple portfolios behind each other. So you've got an A, B, and C. So if you own a bond fund that's lost value, it will sell that automatically and buy the B portfolio of that particular bond fund. And then it waits 31 days and decides whether we're going to go back and buy the original one or keep the one you have based upon whether there's gains or not. And this is all driven by technology.
Yeah.
All of it.
Well, that sounds great.
It's great. Look, this stuff didn't exist. I've been doing this for 30 years.
Historically, Pat, it would be near the end of the year, you'd look at every account, pull up the cost basis the portfolio, run the analysis through your calculator or maybe through an Excel spreadsheet.
Yes.
Highly time consuming.
Yeah. Or
not perfect.
We would just pull from the data across all the clients to see, okay, who has losses greater than $1,000.
But we've been doing this since we began in our career 30 years ago, and as time has gone on, it's the technology.
It will take your portfolio and look at it once a week.
Yeah. So I have another question along those same lines. So if I, what do I keep in my IRAs then? If I wanted my tax,
so
my stocks and my bonds and my brokerage account, what do I keep in an IRA?
What do you have in your IRA now?
Well, I don't invest very well, so I do have a stock portfolio through Schwab, through something called Thomas Partners, and so they own stocks, or it has me owning stocks, dividend paying large cap stocks. And then I have a series of bond funds
in the IRA.
in the IRA.
Okay.
And I'm thinking all of that should be in the brokerage account.
You're almost there.
Which I'm building up because I've accumulated a lot of cash over the last couple of years through my small
Well,
business.
but think about this. So dividends from bonds, interest paid from bonds, are taxed as ordinary income. Dividends from stocks, typically they're qualified dividends and are taxed at capital gain qualified dividends rates, which are lower.
Okay.
And then capital gains rates are lower than ordinary income tax rates for most people.
Everything being equal, let's assume you didn't take any money from these accounts. Let's forget about any long-term estate plan.
And you had
whatever.
$1 million.
You would want all the stocks outside of the retirement account and all the bonds inside the retirement account.
And the reason behind that
assuming there's no people involved in
that you had no emotion and
or income needs.
Yeah, and the reason behind that is because, as you know, a distribution from the IRA is taxed as ordinary income. So you want to put the most tax efficient things, which are things that will appreciate in value and get a step up in basis at death that deliver very, very little dividend or income from them in the brokerage account. And you want all your bonds in the IRA.
Everything being equal and setting aside emotions. The challenge is we tend to not, as humans, we usually don't view the accounts as one. We look at them a little bit differently. One is the brokerage account's liquid, so if we need to buy a new car, whatever, there's the account we can go to. The retirement account, we know it's a taxable event every time we take a withdrawal. We also have required minimum distributions in the future, so it gets much more complex than just the concept
people
of
have a tendency to compare portfolios to each other.
That's exactly right.
Right, and so
they don't make better decisions off that comparison.
That's right.
They make worse decisions off those.
So in a perfect world, you would have your bonds in the IRA and highly appreciated things that you believe will appreciate over time and are tax efficient in the brokerage account. Okay. And my guess is you did not have this conversation with your advisor of the firm you're working with.
No.
And the reason
in fact,
what's that?
I'm about to have the conversation because I've had just accumulated a pretty large amount of cash over the last couple of years, and going to put that into a brokerage account. And then I want to move stuff, then I want to start managing this a lot smarter.
And you said you've got a business. Are you planning on selling that at any time in the future?
It's up in the air. I would like to have the employees take it over. It's a small business. Some kind of
an ESOP,
an employee owned. Yeah, not necessarily an ESOP. The fees would be too high for the size business we are.
Have them buy you out.
Some type of employee owned.
So
maybe a co-op.
That all comes into play with how you invest today as well, because
that'll be taxable.
Dan, that is a. Let me that is a very, very, very tough decision right now to sell the employees the business. If there's a market for the business outside the employees, right? If there's a roll-up happening.
In almost every industry,
there are roll-ups. I get legitimate offers for the business at least quarterly. Yes, there's a market for it.
So the problem with selling to employees, and some employees that are listening to this are thinking, God, this is crazy. Just be quiet.
Right. You made me promises, and now you're going to break your promises.
Right. Well, no, but you can still sell them part of the business. They just get shares in the roll-up that sits above it. The thing you have to think about is that it takes a long time for you to get that risk off the table.
Yeah, that's right.
A long time. Yeah. And quite frankly, some of them may not be capable of running your business.
Well, that's one of the challenges. I'm working on getting them intellectually capable, but none of them are close to being financially capable to
and they probably never will be.
Or the lines of credit, right?
And then you're the one who's carrying the note.
You carry the note,
or you sign a personal guarantee for the financing.
It's a big decision, and it isn't an all or nothing, right? So if you sold to a roll up, you can actually take some of the shares, right? Because it doesn't have to be an all cash deal. Normally they're not. You can actually take some of those shares
and allocate
it to the employees, and actually put handcuffs on it that say you don't get these shares until you've worked here for 3 years
or whatever.
Whatever you want. It is a it is a very, very difficult environment in order to pass a business down to employees.
Yeah. It's an easy environment to sell
I
your
started on
business.
this path 3 to 5 years ago, and I just keep waiting, for the employees who I love, if they're listening, for them to step up and get into this position where they could take it over. And I'm approaching 66 now. I had to work for a long time. Mainly what I want is I want a company, I want to get out of the day-to-day management, but I want a company that I can comfortably work for into my 70s.
Okay.
And so I'm trying to.
I don't know. So I don't know the industry, but I'm writing a book right now with Forbes Books on all the things to consider when selling your business to either private equity or private equity backed firms. Right. There are so many in almost every industry right now. There's private equity involved, and there are these private equity backed firms that are buying smaller companies and rolling them in, and it's designed for people like the Dans who maybe they want to retire, but oftentimes they're people that got tired of. They're great at whatever their trade is, their skill set. They want to get back to doing just what they enjoy doing. They're tired of running a business.
I don't want to deal with insurance, copiers.
Right.
And
that's exactly my position.
And Dan, the thing that you forget is that your risk tolerance is much higher than those people that work for you.
Oh, yeah, absolutely.
Right? Because how long ago did you start this business?
In 2002.
Okay.
But I've been in the industry since 92.
What percentage of your net worth does this business comprise?
My net worth, maybe a quarter, depending on what I could sell it for.
Okay, good.
Yeah. Okay. And the other thing to remember is in that time period that you started the business till today, was there months or quarters that you missed a paycheck?
Never.
You've always been able to pay yourself.
Oh, myself?
Yes.
Oh. No, I have missed a paycheck.
Right?
I've never missed the payroll, but I've missed
not
the
payroll.
paycheck.
Yeah, you've missed paychecks to yourself.
Right.
Right? And the reason you did that is because you had faith in the long-term viability of the business and things would get better. Correct?
Yes.
You go to your employees and say, okay, you're going to own this business. Oh, and by the way, over the next 5 years, there's probably going to be a 3-month, 6-month period where you don't pay yourself.
Right.
It would it has such an emotional impact on them that it's really, really difficult for them to comprehend that.
Yeah.
I tell you, I have a neighbor that sold his business to his employees, and he said to me, look, I know it wasn't the best financial thing to do. He said, but my team was ready. And they were ready. He said, I haven't had any problems in the transition whatsoever. But he said, it could have gone either way. Right?
Yeah.
So you have to assess those people around. Everyone raises their hand when it looks free.
Right. Oh, absolutely.
Yeah. When everyone says they want to work for themselves.
Yes, until they do.
Yeah, that's right.
Right.
Anyway, it is a big decision. And you might want to actually sit down with someone who's done it, or when Scott's book comes out to read it.
Okay. I will look for the book.
And frankly, I would think also talk with a financial advisor who has had experience with these things, because some of your planning today is probably going to be a little different if there's an anticipated sale of a business in the next year, 2, 3, 4, 5 years.
How many of these, we're a platform that rolls up other firms. How many have we done? I did 31 myself.
We've done like 42.
43. And about, I'd say 85% of the time, being fair, 85%.
I don't know where you're going with 85%.
Is that the people that have sold are neutral or happy.
Okay.
Oh, yeah.
And about 15% of the time,
it's all a mindset thing.
Yes.
It's 100% a mindset thing.
And 15% of the time, those that have sold have said, this was terrible. You came in and changed things. And we're like, yes, we told you we would.
In our mind, making them better.
Yes, in our mind, making them better. But
better
in their
experience
mind,
for the client. But
in their mind, less control.
Yeah.
That's what happens.
Yeah. Right.
You go from being the man to working for the man.
Right. Which
so it is a mindset.
I feel if everything collapsed, I could go and work for somebody else tomorrow if I had to. I still have significant value in my industry, but I don't want to. Right.
That's right.
You don't want to do
That's
that.
right.
But you might want your next chapter to not have to deal with all the stuff to run in the business that you have to deal with, and just
I definitely don't want that.
And just focus on what you enjoy doing.
And large organizations always have room for that.
Yep.
Yeah.
Right. We have
some of our top advisors were small business owners. They went independent years ago. Now they're part of the Allworth team. They shed all that stuff they used to do of running the business. Now they can focus on being the best financial advisors they can be. They're having a ball. Their clients have great outcomes.
Right. Yeah, and then you backfill them. As I had a little bit about our firm, I had one advisor say, "Look, I gained 40% more time in this transaction. I left half at the company and took half for myself."
Great.
Right?
Yeah.
So what's that mean? He says, I travel a lot more. I actually, he bought a vacation home. He's just like, and he said, I've never had to deal with anyone in HR. No one's ever come to my office. Yeah. Right? You get it.
Yep.
All right, Dan.
No,
right,
well, thank you very much.
Yeah, say what you were going to say. The what?
The worry is, I have some employees that have been with me 10 plus years. I understand that I would do well. I just want to make sure that my employees
I think,
are in a position to do well as well.
I think, well, then when you're looking at your partner, who you might end up partnering up with, selling to or whatever, that's a big consideration. And where would they have the best career opportunities? And frankly, we look at Allworth, we're 500 and 600 employees somewhere in there. Like a lot of our leadership have come to us through these other firms that someone used to work for a firm and there was 5 employees. Right. They had did all kinds of things. Part of a large organization, they can thrive in their own unique abilities. So
that's what I think too.
Not everybody, right? There might be some that don't want to.
And you could still tie them into equity.
Yeah. Yeah. Okay.
So, anyway, congrats on, you said you started the business in 2002?
Yes. Yeah.
Yeah.
Good for you.
Yeah. Someone asked me, what was it like running a business? And I said, it was a lot of fun until it wasn't.